Frontline stocks continue to climb slowly higher even as mid-caps take a beating. Energy and FMCG are the key gainers, while consumer durables and metals slip.
Gujarat State Corporation and Gujarat State Petronet will merge into subsidiary Gujarat Gas, while the transmission vertical will be spun off into a separate entity. Analysts see significant gains from synergies, cost and tax savings following the scheme of arrangement.
Bajaj Housing Finance will float an IPO of 6,560 crore rupees to raise 3,650 crore rupees via a fresh issue of shares and 3,000 crores via an offer for sale. The offer will be open from September 9th to 11th. The Bajaj Finance twins, they jump on the news.
Two-wheeler players clock strong sales in August, as do SUV makers in the passenger vehicle segment, but commercial vehicle sales hit a rough patch.
Crude slides after OPEC Plus decides to roll back output cuts over 12 months from October this year. A tempering of expectations on the magnitude of Fed's likely rate cuts also hurt sentiment. Hello and welcome to Halftime Report. I'm Nigel D'Souza. With me is Ekta Batra. Well, Ekta, it's that sort of a day. We're bracing for a record, something that we've never seen. That's 13 straight sessions in the green. And for the time being, we're holding in the green. The screen is not very convincing because you have the mid-caps that are underperforming, but we'll take it.
Well, at least it's not Friday the 13th, That's true. So let's see whether that takes place or not. But nonetheless, it's just about higher by around 52 odd points for the Nifty, the mid-cap index, which is underperforming at this point in time, so down around 0.3%. We have the Bank Nifty, which is absolutely flat. But we do have a lot of companies and a lot of ground to cover in the next 1 hour. So let's start and kick off the show with the first management on the show today. We have Aarti Drugs. They have, in fact, approved a buyback recently worth around 60 odd crores, and also they are in focus on account of an antique note which says that API prices have fallen sharply over the past 12 months, and there could be some amount of consolidation in the industry. To discuss this and more, we have Adish Patel, who's the CFO of Aarti Drugs, joining in. Mr. Patel, thank you very much for taking the time out. Well, you know, this antique note was quite comprehensive in terms of indicating that there is a continued reduction in the prices of key APIs. Give us a sense in terms of what you are seeing on the ground, because the quarter gone by was quite weak for you all in terms of revenue. So how much of lower API prices played into the quarter for you all?
Yeah, correct. Based on our feeling, the actual fall stopped in the March quarter. In the June quarter, as far as the domestic prices were concerned, there was hardly any 2% drop vis-a-vis March quarter, June versus March quarter. However, it was the exports where the fall was sharper in terms of selling prices. But that was mainly on the account of the fact that most of the companies like us, API companies, have an order book of around 2.5 to 3 months. So in March quarter, we were realizing December quarter's prices. So it was in June quarter that we realized March quarter's prices. And that is why there was a downfall in prices in the export market.
Okay, so what is the current trajectory in terms of prices right now for APIs, and has it settled, and what does this mean for business for you all?
Yeah. So the antidiarrheal segment, antifungal segment, and antibiotic segment as well, the prices are stable since April. Means it is not moving. Yeah, definitely there might be some input price variation for a certain product, and based on that, the selling prices of that particular product might change. But on a portfolio level, we are not seeing any price variations in domestic market for the APIs since April.
Hi Adish, good day and good to see you in. This is Nigel on this side. This buyback news, the street liked it, but don't you think it's a very small one? You could have done a little larger one.
Yeah, actually, we used to do steady shareholder payout every year, and our company policy is that around 25% plus minus 2% shareholder payout we always do. So we thought that right now there was an opportunity to do it before 30th September. So we thought that we will upfront it. So basically what we are seeing is that for the last 8 years, whatever the profits are there, it will be around 26% of the total PAT. So very much in the company's policy book, according to the company's
Right.
policy book.
So in lieu of the dividend and ahead of that regulation coming into play, you thought it's a good time. Got the rationale with regard to the buyback. I was just wondering whether you could have done a larger one, but I'll take that reply. Let's focus on business then. You started off the year on the back foot with the degrowth in the first quarter. But for the year, you were looking, I think, at a 10% growth in revenues. Do you stick to that for FY25? And also, if you could give us, what is the margin trajectory from here?
Yeah, that's a very interesting question, actually, because definitely when we started the year, we thought that around 14-15% volume growth and around 7-8% negative price variation. And according to that, based single high-digit revenue growth we will achieve for FY25. But based on the first 5 months, definitely there was quite a slowdown in terms of purchase by the formulation. The government tenders across the globe was very low. In fact, we got some sense from our export managers that right now the inquiries are picking up for the export market. So from here onwards, the volume growth could be good. But then because we had bad first 5 months, the overall FY25, we would like to revise down the revenue growth as far as value is concerned in low single digits.
Okay, so when you say low single digits, it's up from, say, 1 to 5%.
Yeah, correct.
Okay, what would that mean for margins? Because you did around 11 to 11.7% in the previous quarter. Based on what you are anticipating when it comes to, say, growth as well as inquiries picking up, what are you anticipating on margins?
Yeah, so the margins definitely, one more impact on margins was because of the new greenfield project which just went online for the dermatology project. Obviously, we are having a little bit of teething trouble in terms of scale-up batches. Nothing to do with the process. It is just the physical properties of the material which is causing a bit of problems, but it will get sorted in a month or two. So once we scale up that, and also the demand from export will come back. We are expecting it to come back. Already we are seeing it. So we are hoping that the outgoing quarters, like December quarter and March quarter, we should be able to cross 13% EBITDA margin.
13% EBITDA margin. All right. Let's focus on a smaller part of your business, the specialty chemical segment. There you're going to run rate, I think, of around 25 crores per quarter. But I believe that you're expecting a sharp jump over year in revenues. So for FY25, FY26 on an annual basis, what should we be looking at from this segment?
Yeah, so FY25 would be a very short time to look at because our second greenfield project will be just going online in next coming quarter. It's almost there. But for the next FY26, we hope that, almost anywhere between 50 to 100% increase in the sales of specialty chemicals.
This year, you're going at a run rate of around 100 crores approximately per annum, if I take 25 and annualize it. So you should end in the vicinity of around 100, 110 crores. So for the following year, since you're saying a 50% jump, we should look in the vicinity of around 160 to 200 crores. Doable?
Correct. Yeah.
Okay. So you're not anticipating that 50% growth to come in based on what you indicated in your conference call, which would be predicated on a recovery in second half.
Yeah, so probably the jump might be there, but we are just being a little conservative on the estimates, looking at the current market scenario.
Okay. All right. You also have this 4,000 crore revenue guidance by FY27. And you all have said that you all are on track to achieve it as long as you're assuming current prices. Right. Are you on track to achieve it?
It will be slightly difficult. FY27 would be like, means after this year, two years more. But definitely we would cross, we will end up somewhere between 4 and 4,500 crores by FY27.
So you are sticking to that guidance then?
Yeah, between 4 to 4,500 crores. Yeah.
Okay, all right. And your debt as of the last fiscal year was around 560 crores, but you've got some capex plans that you're putting on. So how does this number shape up? Will you reduce debt from here, or because of the capex, do you see it increasing?
So the new project capex we are doing with term loans as well. But overall, there are strong internal accruals also. So last quarter, the debt to equity ratio was in fact quite low, around 0.4. by the end of June quarter. And we don't expect that the peak debt to equity will go beyond 0.7 or 0.75, considering the buyback, capex and everything. But that will all just be for a short while, and again it will start going down.
Okay, your export APIs, that was what was sluggish in the previous quarter. Where does that stand in terms of a demand pickup now, and how does the domestic demand look like compared to that?
Yeah, so domestic demand has been good, except for one antibiotic product, which is not having a demand, and that is quite a significant product for us. But other than that, rest of the portfolio is doing quite well. In fact, the good news was that a lot of export countries, they have started opening up the government tenders, and in turn, there will be a lot of API demand for the exports. So it will look quite good in the second half of this financial year.
Okay. All right, Adesh. Thanks a lot for joining in and filling us in with all of those details. So the market is still a little bit sluggish. That's why you revised your near-term guidance downwards. But you're saying for 2027 that 4,500 crores of revenue guidance is well and truly on. For the time being, the stock has moved a little bit lower, but the management sounding optimistic about the next few years. Near term, there are some headwinds. Well, let's slip into a short break. On the other side, we'll put the spotlight on Gujarat Gas restructuring scheme, which proposed a merger of GSPC, Gujarat State Petronet, and GSPC Energy into Gujarat Gas. Stay with us.
Welcome back. Well, it's been a good amount of traction for the Bajaj twins. We have Bajaj Finance as well as Bajaj Finserv, which is gaining. And remember that on a month-to-date basis, both these stocks have done quite well. So it's not only today that we're talking about. You're talking about just about the start of September. So let's, it's been a good rally that they've seen. So Bajaj Finserv is up around 4% today, and Bajaj Finance up around 2.7%. On a year-to-date basis, if we look at that, it's up around 10% for Bajaj Finserv and Finance, which is just about flat on a year-to-date basis, but seeing good amount of traction today. But let's move on. The big story that we're tracking today is Gujarat Gas, which has zoomed nearly 8% following a major restructuring scheme, which proposes a merger of GSPC, Gujarat State Petronet, and GSPC Energy into Gujarat Gas. Nimesh has been tracking the story, and he had an inkling all the way a couple of weeks back on this. But Nimesh, over to you.
Well, thanks, Ekta. So, very interesting restructuring which was announced over the weekend within Gujarat Gas, Gujarat GSPL, as well as GSPC. Now, essentially, this scheme of arrangement has been largely been proposed for simplifying the structure as well as value unlocking for the shareholders as well. So, when I mean simplifying the structure, let's look at the structure first. What is Gujarat Gas currently? I mean, what not done approved is merger of GSPC into Gujarat Gas, GSPL into Gujarat Gas, as well as demerger of GTL. Now, if you look at the existing structure of the holding, Gujarat government holds a majority stake in GSPC, which is unlisted, and then now first talk about the share ratio for Gujarat. So basically, a merger between GSPC and Gujarat Gas, the ratio is 10 shares of Gujarat Gas for 305 shares of GSPC. For GSPL, which is a listed entity, you'll get 10 shares of Gujarat Gas if you're owning 13 shares of GSPL. And after the merger, there will be a demerger of the trading business, which will be called GTL, and you'll get 1 share of GTL for 3 shares of Gujarat Gas. So that's the structure. It's a 3-step structure which has been announced. Now, as I said, it's largely been done to dismantle the holding structure. What is the structure currently? Gujarat government owns 55.6% in GSPC, which is unlisted. Now, GSPC in turn owns 37.5% in GSPL, which is a listed entity, and GSPL in turn owns close to 54% in Gujarat Gas. That's the holding structure currently. After the restructuring, there will be two separate companies which will get listed. One will be Gujarat Gas. Now, that will hold the city gas distribution businesses, the gas trading, E&P, and the renewable business, and the related investments. So this will be one entity where all the companies will get merged into. The second entity will be GTL. Now, that's the trading business of GSPL, which will be carved out as a separate business and list separately. Now, GTL will have the gas transmission business and the related investments, including the cash as well. So that's what the restructuring will look like. Two businesses, Gujarat Gas as well as GTL. Now, what our brokerage is saying as far as Gujarat Gas is concerned, couple of interesting reports. Equirus today has actually upgraded the stock to an add And Antique has a target price of 726. They believe that the merger is value accretive. Even Equirus had put out a note on Gujarat Gas. They actually upgraded the stock to an ad with a target price of 667. And they believe it's a well-thought merger. And post the merger, Gujarat Gas will become the second most, second big company in the gas trading space. So that's broadly what the analysts are saying. In fact, Jefferies was slightly negative on the stock, but post the merger, they believe that the fair value could be close to 513. But they still believe that earnings could be volatile and there could be some impact on the gas margins post this merger. So mixed view from analyst point of view, but the stocks are reacting pretty hard. I guess the two big takeaways: one, it just simplifies the holding structure between the Gujarat Gas and GSPC and GSPL, and two, a bit of value unlocking for the GSPL shareholders.
Okay, all right, Nimesh, thanks a lot for that. Well, auto sales numbers for August as well are in, which shows that two-wheelers and passenger vehicles have done well. Sudarshan joins us to break those numbers down for us. Sudarshan?
That's correct. So amongst all these segments, two-wheelers have outperformed. In the four-wheeler segment, passenger vehicle segment has done better than commercial vehicle segment. In two-wheelers, all the three companies, TVS Motor, Hero MotoCorp and Bajaj Auto, have reported sales. Those were much better than estimates, with total sales coming in the range of 5 to 16% year on year. And in the segment-wise, motorcycle segment is the one segment which continues to lead the growth for all the three companies. Starting with TVS Motor, total sales were up 13% year-on-year and 11% month-on-month. Two-wheeler segment, that is motorcycle and scooter, have seen growth in double digits on year-on-year. Hero MotoCorp, total sales were up 5% year-on-year and 38% month-on-month. Here, motorcycle segment was up 6% year-on-year and 41% month-on-month. For Hero MotoCorp, even outlook is positive. Company says it expects strong growth in upcoming festive season. For Bajaj Auto, it was a strong set of sales. All the segments have reported growth, and growth was coming in the range of 5 to 24% year-on-year. Two-wheeler segment continues to lead the growth for entire segment. That was up 18% year-on-year and 13% month-on-month. Even for Bajaj Auto, even three-wheeler segment has seen growth both year-on-year and month-on-month. In four-wheeler segment, Tata Motors sales were much below estimates, and that was dragged by commercial vehicle segment. In commercial vehicles, except passenger carrier, all the segments have seen a drop, with CV sales seeing a fall in the range of 21 to 23%. For Maruti Suzuki, sales were almost in line with estimates. Talking about positives for the sector, utility vehicle, that is the SUV, have seen growth both year-on-year and month-on-month, and sales to other OEM remain more than 10,000 units. Negative compact segment, that is the starting segment of the company, remains under pressure. For M&M, sales were much better than estimate. SUV continues to lead the growth. Tractor sales were slightly below estimates or almost in line. Total sales were up 9% year-on-year and 16% month-on-month. SUV sales remain healthy, with a growth coming at 16% year-on-year.
Okay, all right, Sudarshan, thanks very much for that. In fact, M&M's August auto sales, which have come in above estimates, was driven by SUVs. The CV segment witnessed a sharp rebound month-on-month, but tractor sales are below estimates. Earlier this morning, we did speak to Vijay Nakra, who's the President Automotive Division at the company. Listen.
I think what's augured well is, as we start moving up to the festive season, we are seeing inquiries go up. That's one. Two, also the numbers that we have delivered in the month of August are backed by retail. So it's not just building in stock for the festive season. If I look at the Vahan registration data for the month of August, if we add Telangana, which accounts for about 4 to 5% of all India retail, we're at 98% of our wholesale numbers. And we've actually gained about 2 percentage points share on the retail front. As far as the overall numbers is concerned, we had said that we have a capacity of 9,500, fungible between both the 3-door and the 5-door. That's right. 16th is when we start test drives, and 3rd of October is when we open bookings.
All right, time to slip into a short break. On the other side, we'll get chatting with Aditya Agarwal, Head of Research and Investments, who will be joining in with some trading strategies. And we'll also get you an update on the derivatives market. Don't go anywhere. Welcome back. Well, let's take a quick check on the options data then. We are up by close to around 50 points. Would you pull up some of these strikes? The 25,300 call, which should come up for you on the screen. Directionally, you've got the call right, but there is writing being seen at those levels. So in spite of seeing a 55-point uptick on the Nifty, you're not making money out there. That's telling you that the bears believe that they can defend higher levels from here on. Remember, the PCR has moved to the upper end of the range as well at around 1.4. So that's one data point. Even the 25,500 call out there as well, directionally you've got the call right, but there as well the premium is down. So you're seeing call writing that's coming back into play. The positive, though, is that you want the nearest possible strike to see a fair bit of addition, and that's precisely what's happened. So the 25,300 put, well, that's seeing some bit of addition as we speak. So, that's another data point that should come up for you on the screen. So in the near term, it appears the bears believe that maybe we're at the upper end of this range. Pull up the India VIX as well. The Nifty is higher in today's trading session, but I think we should get the India VIX as well. That has seen a sharp correction down to around the 13.5 odd mark. So normally when you see the Nifty moving up and you have the India VIX as well moving the same direction, maybe there is some cautiousness that's creeping in there. It's an inverse relation normally between those two. So keep that in mind. Aditya joins us to help us out with his trades on the Nifty. Hi Aditya, good day. Good to speak to you after a while. How are you approaching trade first on the headline index, the Nifty and the Nifty Bank, and then we'll get to your stock calls.
Good afternoon, Nigel. Yes, been some time we spoke. Markets have entered into consolidation, I would say. After a good up move that we've seen from 24,200 odd levels, it's been a one-way rally for the Nifty. Bank Nifty, unfortunately, hasn't been that great. It has underperformed the benchmark index. Nifty, to me, right now does look like little overbought, and then you can see signs of fatigue in the Nifty, especially. And as you mentioned, 25,300 is where you're seeing some bit of call writing as well. So I believe this zone of 25,300, 25,400 will see some kind of a resistance going ahead in trade today and maybe for this week, entire week. And markets can cool off a bit closer to about 25,200, about 25,100. I don't rule that out, about 150, 200 point correction on the Nifty. The Bank Nifty too is locked in a very tight range, Nigel, 51,200 about 51,000 on the downside, immediate support levels, and on the upside 51,500 to about 51,600 is acting as a hurdle on the upside. So overall, I would not trade the index on the long side, both the Nifty and the Bank Nifty for sure. I would wait it out for maybe a minor dip in the market and then go long. If at all you're looking to go short, on the Nifty, maybe look for a short trade with a stop loss just above 25,400 and look for a target of 25,000 to about 25,100. The risk to reward could be just 1:1. I don't see too much of a downside as well in the Nifty as of now.
Okay, stocks?
So I've got a couple of recommendations. Both will be on the buy side because there are sectors and stocks which are outperforming. Look at IT, for example. They've been constantly outperforming, and I think there is still some room left for these IT stocks to continue to go up. So LTTS is something which is looking very interesting to me on the chart setup. It's on the verge of a breakout from a major resistance on the monthly time frame. So I think from here on, LTTS can enter into a new orbit altogether. If you buy at current levels, the immediate targets will be 6,100 to about 6,200 on the upside, with the stop loss at 5,700 on the downside. So that's a buy recommendation on LTTS. The second is Titan. Again, after a good up move, stock went into a consolidation phase. Today, it's showing signs of strength in a non-market like this. So I would go ahead and buy Titan for a target of 3,750 on the upside with the stop loss at 3,500 on the downside.
Okay, all right. Thanks very much, Aditya. We're going to leave it on that note. Thanks, and thanks for joining and giving us all of those picks. We'll take a short break. But up next, we'll connect with Ameera Shah, the promoter and MD of Metropolis, to discuss their business. Stay tuned. Welcome back. Well, quiet for the markets overall. We have an advanced decline ratio, which is favoring the declines at this point in time. So let's see whether that reverses and whether, Nigel, we manage that 13-day run in terms of gains for the markets. But nonetheless, let's talk about one particular company now. Metropolis Healthcare is the next management on our show. The stock is up over 50% in the last 1 year. It's rallied around 60% from its 52-week low. It reported what was an in-line Q1 FY25 performance, with the company guiding for around 13 to 15% growth this fiscal. We have with us Ameera Shah, the Executive Chairperson and Whole-Time Director of the company, to talk more about the outlook. Ameera, hi, welcome to the show. Well, Let's start with the Q1 numbers. What stood out to me was your Mumbai market growth, which was up around 18% in the previous quarter. This is one of the most competitive markets when it comes to diagnostics. What's taking place there? What's resulting in this double-digit growth that you're seeing in the Mumbai market? And is it sustainable? What are you going to see in FY25?
Ekta, actually, if you've seen the last, I would say, maybe 4 or 5 quarters, we've been showing the same growth in the Mumbai market. So I do believe that it is sustainable for this year. Look, I think, healthcare is really driven by science, how good you are, what your expertise is. And market competition really doesn't play as big a role because this is not a pure play consumer business, which is driven by price and convenience, but it's really a business which is driven by how good your quality of report is. And of course, combining that with great services and appropriate pricing, etc. So I think with the kind of distribution we're building, the kind of approach we have to the market, as well as the fact that we have a very solid product and service, I think is really what is just leading to this growth. It's just unwrapping and unveiling of the untapped potential that has always been there for the brand.
So for Mumbai, what is your market share currently? How much do you expect it to increase? And if you could just touch upon the competition dynamics in the city as well.
See, I think there's no really third-party information about market share available in our industry. So any number I give you will be just instinctual or our internal calculations. So according to us, we probably have about sort of a 15 to 20% kind of a market share in Bombay as an internal estimate. We do believe that we can take this to a 25 to 30% number over the next few years. And that is our attempt through the B2C as well as the B2B route. In the last few quarters, what's interesting is while we saw a rapid growth for Bombay as a city on the B2C side, we weren't seeing as good of a growth on the B2B side because you kind of have to choose between the two for any market. But in the last quarter, what was interesting is we've now also seen the B2B side grow up, sort of growing much better than even last year. So, we are certainly very hopeful about this continuing. I think the competitive landscape is there are, a few good brands in the city, which do have chains, but majority of the market, which is 85% of the market, is approximately, unorganized. Or maybe 75% of the market is unorganized. So I think the opportunity to grow, the runway for growth is still large. We are nowhere close to being tapped out or sort of capped in any way. So, like I said, the business really grows on the back of how much doctors trust you, how much consumers trust you, and thankfully having a strong brand has been a strong thing for us.
Hi, Ameera. Good day, and always good to see you on the show. Let's talk a little bit about pricing then. I think you'll try to push through a price increase a few months ago. So volumes are back to normal now, and are you trying to push through another price increase?
I mean, I think trying to do multiple price increases is unfair to the customer. So no, I think we did one as of January 24. I think that's ample for this year. We did see a marginal dip in volume, the quarter post that, which we think is normal. We have seen, volumes sort of come back to where we expected them to be. And Q2 usually is a better quarter than Q1 anyway. So we're not really, I wouldn't say that volume is a big concern at this point of time.
Okay, so what about True Health and Specialty? Because, those are your key drivers in terms of growth. True Health, which is wellness, was up 28% on a year-on-year basis in Q1. Specialty was up 14%. Give us a sense in terms of what's driving this growth and whether this kind of double-digit growth is going to continue. What are the estimates that we're seeing in FY25?
See, wellness is basically more driven towards consumers, where people who are either well or people who are unwell are basically opting for more bundled packages, saying that, look, if I'm getting bled one time, might as well instead of doing 3-4 tests, let me do 10, 15 tests at one time. And that wellness, what we are calling, is including the bundled packages as well. So that we are finding as a consumer trend is certainly on the increase. So we do expect to continue to see it growing, at a fairly rapid pace, much faster than the regular company sort of growth. So that's one. I think the specialty is a very interesting part for Metropolis because as probably the leader in specialty testing in India, we have almost 40% of our revenue coming through the specialty route, which really means that doctors for the most critical illnesses When you have a stroke, when you have cancer, when you have brain damage, when you have something very significant, you're really reaching out to Metropolis to say, look, I trust their reports in the most critical times because accuracy plays that important role. And I think we are continuing to see that area continue to grow really well for us because, again, that trust is growing across all markets of India. And for that, your precision, your test menu, your variety of test menu, and we offer about 4,000 varieties of tests. And the precision of the test is very, very critical, because you're really talking about life and death potentially for a patient. So we are seeing both these areas grow very well. And the specialty is not only B2B coming through hospitals, but also coming through specialist doctors who are asking their patients to come to us for testing.
All right, Ameera, with regard to the year, let's talk a couple of numbers then, because a lot of our viewers, shareholders would like to know that. I think earlier you were guiding for 13 to 15% revenue growth. So do you stick to that? Point number one. Point number two is on margins. You're in the mid-20s. That this is the sustainable number, 25% odd margins?
So, we guided for this year approximately, like we said, 13 to 15. We stick with that number at this point of time. And margins, I think we've maintained that this year will be sort of in the similar range. We feel quite comfortable at those numbers. So I think this year, as we know that we've always mentioned that we have about a percentage dilution because of the rapid pace of lab expansion that we've been doing the last few years. And this year is the last year of the rapid pace. We've been doing this from 2021 till now 25. And from next year onwards, the goal, while we'll continue adding few labs like we used to in 2019-20, maybe 5, 6, 7 labs a year, but the pace of adding 30 labs a year will definitely come down. And the focus will move again back to adding collection centers to really be the feeders that then feed all of these labs. And the collection center network will move into a rapid pace, which is far more asset light and not capex heavy and does not dilute sort of the margin profile either. So I think, we see obviously a very positive outlook, for the organization going forward.
So 25% margins is what we can expect as a base?
At this point of time, the number of 25% is what we would expect for this year. And like we said, there is some, margin dilution already happening, which is already baked into this, which will certainly get released over the next, period of time. But we'll obviously continue to invest in other areas. So we would like to continue to sort of, stick to this number of 25 to 25.5% kind of a number for the margin.
Okay, all right, Ameera, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's Metropolis. That stock is just about lower by around 0.8% at this point in time, sticking to that 13 to 15% revenue growth guidance for FY25, looking to increase market share in the city of Mumbai to probably 20 to 25% in the longer term. We'll take a short break, but we'll get you more on the markets. A lot of stocks in focus. Stay tuned.
Welcome back. The bears seem to be fighting back. The Nifty mid-cap index is at the low point of the day, and the Nifty as well has come off from nearly a 100-point gain. We're up only around 35 points as we speak. So the bears are trying to put in a bit of a fight in today's trading session. But let's move on. In the backdrop of CNBC-TV18's Banking Transformation Summit 2024, my colleague Ritu caught up with Shyam Srinivasan of Federal Bank and Mr. Ashok Vaswani of Kotak Mahindra, and started by asking about KVS Manian's departure from Kotak Mahindra and his subsequent move to Federal Bank. Let's listen in to a slice of that conversation.
It's always great to have colleagues take over other companies, right? Yeah. Because then we are friends, and I'm really glad Mr. Manian got the Federal Bank job. Yeah. Sad to see my old friend go, but it's wonderful to have a friend at the helm of the company, and I wish him very best of luck.
Okay, and Mr. Srinivasan, your gain, what is the word of advice that you'd have for your successor from Mr. Vaswani?
No, I'll tell you, for Manian, the best thing I would like to give as a gift is a superb platform, right? I've always said that we're playing a test match. Yeah. The first 2 tough days we've seen through, he has a great chance to accelerate and build a fantastic bank. We are determined to be the most admired bank. With due respects to my dear friend, we will be the most admired bank. And I think Manian has the opportunity and will make it absolutely the best in the country.
What is the unfinished business you'd like your successor to take on?
This is a long journey, right? We are searching excellence. There's no finish line. So Manian will build it to another level and his successor will build it to another level, but we're pursuing most admired. And most admired is earned, pushed very hard, and I'm sure he will take the torch further there.
Well, Mr. Vaswani, you've taken over at a time when the bank is facing challenges with respect to the RBI embargo as well. It's been a few months now since April. Of course, in your letter to shareholders, you said it is evident perhaps more needed to be done. How far ahead are you in that journey, to sort of, get out of that embargo, satisfy the regulator? What progress has been made?
So I think we've made very good progress. The teams have been working very hard at it. But ultimately, it's for the RBI to give us the green light, and we're working very closely with them. And fingers crossed, hopefully they'll be pleased with the efforts that we've done.
But so far, what is the impact you've seen? Because, you cannot have new credit cards, onboarding through digital channels. What is the sort of impact we should expect?
So as we kind of talked about, and we've also done at the earnings conference, we've had a certain amount of impact. We quantified that. It's unfortunate. We'll work hard to put it behind us and move ahead.
Well, speaking of credit cards, that's emerged as an area of stress. Last year, we were talking about unsecured credit. Many were brushing it off as something that is the problem of fintechs. And now we're seeing that show up in the credit card portfolio, perhaps even spreading to MFI. How long before we see a sort of turnaround in this segment?
I think it's a little exaggerated. I don't believe it's a systemic issue. It could be specific portfolio for specific companies. I haven't seen any substantial deterioration for the reasons we've always said, right? The way credit is underwritten is materially different than it was a few years ago. So unless you've given all the controls a go and missed everything, you can't see a dramatic deterioration. Yeah, there will be pockets of stress, but within a range, and I don't believe it will be anything of the magnitude that is visualized. And the regulatory interventions that have come in the last 6 months have cooled it off. So I don't believe it will be a material problem.
Well, we're now some time away from just talking about the challenge of NPAs, and now we move from the fight against bad loans to the fight for deposits. Let me just quickly touch upon that because, household savings not going into plain vanilla bank accounts, also looking at chasing other higher yielding assets. Do you expect that to sort of curtail the credit growth because deposit growth of the system also continues to lag?
See, look, first of all, I think all the questions in the conference we are previewing right now. But I think the whole idea is, look, there will be customer demand, and where customer demand comes, things will flow to it. Deposits in its totality is not the issue. It's really the quality or the pricing of the deposit. So we will have to adjust for that kind of thing. But these are cycles which we go through, and I'm sure we'll come out in a good place.
Welcome back to Halftime Report. Joining us now is John Reid from World Gold Council. He's the market strategist at Europe and Asia. John, I thank you so much for joining us. And first of all, we have seen all-time high gold prices for the month of August. And would you say that the 25 basis point rate cut has been factored in right now, and the markets are perhaps looking at further development or event?
It's very clear to me that we've seen a lot of expectation of Federal Reserve interest rate cuts come into the market, particularly in the last few months. So the whole world expects the Fed to start cutting rates in September, and for that to be the start of a process that will continue for quarters and maybe the year to come. Now, normally, interest rates, an interest rate cutting environment is very good for gold. And that could be the case, particularly if the US dollar weakens. The only concern that I have is that we've had a lot of anticipation of that in the market already. And high prices have started to have an impact on certain segments of the gold market, particularly on jewelry demand, which we saw weaker in the second quarter already because of high price increases. So I think the market's finely balanced here. First of all, the Fed has to deliver rate cuts, otherwise I suspect we'll see a correction. But even if we do see rate cuts, there may be limited potential for gold prices to trade higher.
John, as you said that the jewelry demand is a bit of a dampener here, but the world's central bank buying has been quite strong. Record highs actually in the last couple of years. Also, would you now see investment demand increasing? Because you're looking at 22% of gains in gold for this year, and the ETF buying seems to be returning too.
Well, I think you've hit upon the really important topic there, and that is of the purchases by exchange-traded fund investors. Over the last 3 years, we've seen slow, steady outflows of gold held by exchange-traded funds, particularly in North America and Europe. The only area we've actually seen inflows in ETFs recently has been in the Indian and Chinese ETFs, but that's showing signs of beginning to turn around now. If I look at the potential for ETF investors to return to the market, that could be the missing ingredient to see gold trade higher over the next few quarters and maybe the next year or two, simply because they've been absent from the market. Now, other aspects of the market have been really strong, such as central banks, as you've mentioned, and there is some signs of slowdown in terms of central bank purchases this year, particularly after China stops disclosing increases to its holdings in May. So we will probably see strong central bank buying this year, but not quite as strong as we saw in 2022 and 2023. So something else needs to come to the party. Emerging market investors, emerging market consumers of gold have bought a tremendous amount of gold in the last few years, and most of that strength will continue. But really, we need to now see Western investors return to the market. And I guess the key ingredient for this is going to be interest rate cuts and slowing economies. Of course, if we get a recession, then all bets are off, and I would expect to see gold attract much more in the way of Western investment. But even in a bit of a slowdown, which seems to be priced in at the moment, I think we can see more Western investment buying.
And those numbers clearly seem to be coming in already. What's also your sense, John, on India gold imports, which are at near record high prices right now? Do you see an impact on that number?
I mean, there was no doubt that higher gold prices were having an impact on jewelry demand in the second quarter. But then, of course, the cut in import duties that we saw last month have reignited interest in gold. And from what I understand from speaking to my colleagues in the World Gold Council office in India, plus we're talking to people on the ground here, jewelry demand and purchases from the gold industry is really strong at the moment. And I think that has the potential to not rescue, but certainly reflate the imports such that we end up with a decent year this year again.
All right, so a good number this year yet again. But when you look at the global markets, John, and there are geopolitical events which have impacted gold prices, what also is your take on de-dollarization debate? And that in turn also has been supporting gold buying, by the way.
There's been no doubt that the geopolitical events have caused short-term boosts for gold, particularly when they have come out of the blue in, against expectations. Typically, though, that benefit that we see in the gold price from an unexpected geopolitical event is fairly short-lived. Look, I'm sure in the background of people's minds when they're buying gold, they are aware that we're in a more risky geopolitical environment, but I don't think it's the main reason why people are buying gold. I think there's other reasons for that as well. And of course, potentially the biggest geopolitical event that you're talking about, you haven't spoken about, is the US election, which takes place in November. And that's very finely balanced at the moment with the potential for some quite different outcomes depending who wins. One thing that is for sure, though, is that very large fiscal deficits in the United States and a growing stock of more expensive to fund debt is becoming a big issue. And I think this is one of the biggest drivers behind investment demand, particularly from high net worth individuals and family offices around the world who are really getting concerned about the levels of debt and deficit in the United States. I don't see either candidate, when they're successful, changing that trajectory.
Fair point there. John Reid, thank you so much for joining us on making sense of various events around the global markets and how gold really seems to be taking support from all of that and more chances really of gold prices going higher from where we are at this point in time. Thank you as always. And with that, that's all the time that we have on The Current Show, but Business Lunch will take all the action forward.